afternoon, everyone. Today, we're pleased to welcome back Calgro M3 back to Unlock the Stock. As you know, this platform was created for retail investors to connect with corporate management and get a better understanding of them and their companies. We're joined by the CEO of Calgro M3, Ben Pierre Malherbe, and CFO Sarai Niker, who will take us through the company's presentation shortly. Unlock the Stock is only possible with our technology partner, Lumi Global. You can visit their website, lumiglobal.com, to discover more about their various online AGM and investor presentation solutions. Before we start, we have a few housekeeping notes. The recording of the presentation will, as always, be followed by our Q&A session. The Q&A will be hosted by myself and the Finance Ghost. You can post any questions to either of us by typing them in the chat box at the bottom of your screen. The event is being recorded and will be available on our YouTube channel either tomorrow or on Monday. You'll see an email address before we begin the Q&A session. Please take note of it if you'd like to be added to Calgro's investor distribution list. Slight change from how we normally do. I'm going to now hand over to Lumi to start the Calgro M3 presentation video. So Jonathan, if you could play that for us, please.
Good morning, and thank you for joining us for the Calgro M3 annual financial results for the period ending 28 February 2026. I'm joined today by our CFO, Sarai Niker, that will take us through the financial section of the presentation in more detail a little later, and then we will answer questions at the end of the presentation. This morning we released our group audited financial results for the 2026 financial year, our ESG report, and a notice of the AGM. Today I want to cover a recap of our strategic pillars as shared last year, just to give some context to the numbers. Look at the year under review, look at the underlying business performance. So you will take us through the financials, and then we'll look at the year ahead. In our integrated report from page 10 to 18, we included a detailed message to the shareholders from Sarai and I, providing some insights into the numbers and our strategic thinking behind our actions during the year. And I'm going to start off by just recapping what we see as core and non-core assets as shared last year. Our non-core assets is the assets that we've got no intention to develop in the medium to long term, or smaller projects ending natural end of life. So on the first pillar, we want to dispose of projects the group has got no intention to develop in the medium to the long term, allowing us to focus on a maximum of 5 integrated developments of scale. The rationale here is that it will allow the group to focus with the installation of bulk and link infrastructure on fewer projects and optimize the infrastructure capacity created. Secondly, we want to balance the 2 business segments by reducing the number of projects in the development business by trading out or completing smaller projects nearing end of life, while increasing the Memorial Park footprint. These first 2 priorities inform both our performance and capital allocation decisions during the year, with the group directing its sales and construction efforts towards the completion of the non-core project pipeline, comprising developments outside the group large-scale integrated core portfolio. Thirdly, we want to manage the relationship between the group net debt in relation to our market capitalization. This is a medium-term goal and expect the ratios to come under pressure in the short term. The fourth pillar is a focus on enhancing our staff expertise through strategic skills development initiatives and appointing industry specialists to assist in skills transfer that will be needed in the execution of our Bankenveld project. This targeted approach supports the phased completion and closeout of non-core projects and enable the release of financial, operational, and management capacity for redeployment into core integrated developments. This will also lay the foundation for how we refine the business in the future. As stated last year, we're not changing how we do business, but refining on where we focus our efforts. If we look at the year under review, I think this photo tells a story. This is the photo of the South Hills project in south of Johannesburg, where you can see the last 183 units in the eastern side of the project being completed, with the balance of the units there, allowing us to move on to the western side of the development in the new financial year. Just touching on the key metrics in the year under review, projects reaching the natural end of life with Scottsdene, Levinovelle, that's our retirement village project, and Lifestyle Estate, which inherited when the REIT was dissolved a couple of years ago, the biggest contributors. We saw strong organic growth from Memorial Parks, the launch of the Ruthenberg Park, extending our footprint into the Northwest province. Our net asset value increased by 12%, so we will provide some detail where these numbers came from in her presentation. Our gross margin declined, although the margin was retained above the internal target of 25%. This was a result of the focus on trading out non-core projects. Return on invested capital came down as a result of the investment in infrastructure in the Bunkenveld project, where the investment in infrastructure was not recovered during the reporting period. HEPS also decreased while trading out non-core assets, and the dividend declared remained unchanged. Despite our headline earnings per share declining slightly, we took on more debt to fast-track the completion of non-core projects. So you will run you through the impacts in the financial feedback. If we go to the underlying business performance, looking at the residential property development, the residential property development segment accounted for the largest share of the Calgro revenue and operating profit as core business. The revenue was flat year on year, while the gross profit margin decreased to 24% from 27% previously. This decrease was mainly due to the focus on trading out of the smaller non-core projects. The number of opportunities under construction came down, all underlining the focus on the trading out of smaller projects during the period. The total core pipeline remains substantial at over 31,000 opportunities and exclude projects classified as non-core assets. This 31,000 units is what we define as core projects. So I'm going to start with the non-core projects first. So 70% of the units handed over during the reporting period originated from these non-core projects. These are smaller projects, like I said, trading, reaching natural end of life, and we are in the process of trading them out. As mentioned, the Scottsdene, Levinovelle, and Southfields were the bigger contributors. Although progress was made with regard to the sale of non-core projects, none of these transactions became unconditional and did not reflect in the numbers in the period under review. Looking at the core projects, the Ballard project, we completed 136-bed student accommodation for the University of the Western Cape, and we commenced the construction of additional 630 beds during Q4 of the period under review. We have completed and launched the first 260 units of a mixed typology units constructed during the year. The 260 units is the first phase of 818 units and at the market segment, starting at units of 399,000 rand. Southfields construction commenced with the last 138 units on the eastern side, as the photo showed earlier. And I think the biggest news is the Bunkenveld project that broke ground with a phase 1 of the installation of bulk and link infrastructure. That consists of connector roads and bridges, and is expected to be completed by the end of the current financial year, and does not reflect in the numbers being reported on. Okay, this is an artist's impression on the Bunkenveld District City project, our new project that will become the backbone of the business going forward, with a 15-year projected pipeline yielding 20,000 residential opportunities. The project is strategically located between the Sandton and Waterfall CBDs, next to the Lindborough Park industrial area and opposite the Gautrain Marlborough station, opening job opportunities along the Gautrain corridor for residents of the development. This project intentional will be do a fully integrated project in partnership with the City of Johannesburg and at the lower end of the residential market. Exciting project that we're looking forward to. We've got rights to develop in excess of 20,000 units, like I said, and the first phase infrastructure that commenced with a bulk and link will unlock the first 20,000 residential opportunity in the next 5 years. If we look at the Memorial Parks, the revenue for the Memorial Parks grew by 26% year on year, with margins slightly improving to 55%, and cash received increasing with 11% to 107 million for the year under review. And the period saw the footprint of the Memorial Parks business growing to 6 operational parks during the year by venturing into the Northwest province with the launch of the Rustenburg Park. The lay-by offering is proving resilient and attractive and will be expanded upon. The focus will be on the growth of market share and product sales. In the short to medium term, strategic objective remains cash collections to a level that cover group overheads, allowing the group to commence integrated developments of scale. In the long term, this goal will be return on investment in line with group strategy. The Memorial Park has grown. Memorial Parks is currently contributing 10% of group revenue. It needs to, however, be noted that this ratio will come down once the BDC project becomes a contributing project. For the financial review, I'm going to hand over to Sir Yuri, and then I'll come back to look at the future.
Thank you, Ben-Pierre, and thank you to all those joining us for the 2026 year-end results presentation. Before I dive into the detail for the current financial year, I'd like to first go through the change applied to the accounting treatment for the Bankenveld District City project. This project was historically equity accounted for in line with the accounting treatment for a joint venture, thus including one line on the face of the Statement of Comprehensive Income being the share of profits, and one line within the Statement of Financial Position being the investment held. In the current financial year, amendments have been effected to the shareholders' agreement, which has resulted in a reassessment of this treatment, resulting in the accounting shifting from the joint venture to a joint operation. This change is prospective in nature and results in the proportionate consolidation of the project into the financial results of Calgro M3 from the date of change. I will highlight the material impacts as a result of this change throughout the presentation. Now, moving along to the current year financial results, in particular, the Statement of Comprehensive Income. Revenue has grown marginally year on year to 893 million rand, primarily due to the shift in product mix towards the partially and non-subsidized units as a result of the execution of the strategic pillars as discussed by Ben-Pierre. The developments business remains the main driver of revenue in the period, with a healthy diversification seen across provinces and projects. The Memorial Parks business has shown positive growth in the year by increasing both revenue recognized as well as its contribution to group revenue. The group's margin remains in excess of the target range of 20 to 25%, but has reduced from the comparative period to 27.2%. The higher cost base in the year is attributable to higher holding costs on the non-core projects. Admin costs have increased, but these were contained to 3%, which is largely in line with the general inflationary increases received throughout the group. And then lastly, the share of profit from joint ventures decreased as a result of reduced operations from the relevant projects, as well as the change noted in the accounting treatment for the Bankenveld District City project, which only included 6 months of performance within this line. Looking at the statement of cash flow, the group's increased investments in construction contracts directly impacted working capital cash flows and resulted in cash utilized from operations of 14 million rand. This deterioration from the comparative year includes the increase in the construction contract balance, which was mainly driven by the proportionate consolidation of the BDC project. The lack of finalization of the infrastructure agreement for Bankenveld has negatively impacted cash from operations. However, this is intended to be resolved in the 2027 financial year, which, once approved, will improve the net cash position of the project. Net cash utilized in operations ended the period at 99 million rand. Debt increased by 269 million rand. This increase in the debt base was executed to ensure sufficient liquidity is available to support the first phase of infrastructure within Bankenveld and assist in bridging funding gaps until infrastructure refunds are received. Looking further down, the 1.3 million shares that were bought back in the current reporting period for 6.6 million rand at an average price of 5 rand a share have been cancelled This buyback was done at a discount to net asset value, creating accretive value to shareholders in the long term. The group also settled the dividend, which was declared at the end of the previous reporting year, which resulted in an outflow of 6.5 million rand. This gave us a cash balance of 183 million rand, with the cash position benefiting from the additional facilities raised. At the end of the reporting period, the group's overdraft facility of 100 million rand remained undrawn. Moving down to the statement of financial position, construction contracts remains the largest balance, increasing to 2.1 billion rand. This increase includes the proportionate consolidation of the Bankenveld project, which accounted for in excess of 200 million of this movement. Looking further down, as mentioned, the reduction in stated capital was due to the cancellation of shares which were bought back in the year. And then lastly, on the statement of financial position, as in the prior year, it was discussed that the maintenance liability would be reclassified into its own line. This has been effective in the current year and is a byproduct of the JSE proactive monitoring reviews, which was completed in the prior financial year. As communicated to the JSE, this change was effective in the 2026 financial results. Having a look at our borrowing maturities and covenants, debt levels have increased, as I've discussed earlier, and these facilities were raised in order to secure working capital for the Bankenveld District City project. Refinancing of maturing debt remains a focus and will be assessed as debt falls due. Having a look at our regulated covenants, both the DSCR and net debt to equity are within required levels, with the DSCR at 1.54 and the net debt to equity at 0.74, within the target range set for the group of 0.75. Lastly, the board has resolved to maintain the dividend level in line with the prior year, declaring a dividend of 8.63703 cents per share in the current year. This will be settled in June 2026. Thank you, and I'll give it back to Ben Pierre to take us through the last section of the presentation.
Okay, looking at the future. With the uncertainty of the 2026 election cycle in the back of the minds, the 2026 calendar started with high expectations, although measured. The war in the Middle East, however, resulted in the recovery of the residential market being put on hold. Demand for the entry-level residential market did not change and show signs of recovery during the reporting period. With improved borrowing conditions, we saw greater interest from investor buyers, which market segment recovered faster than the end user sales. We saw greater consumer confidence and stable and reduced interest rates with low inflations, all set the scene for a great year ahead. Then February, war in the Middle East. The high fuel prices will impact transport and general cost of living and undoubtedly add pressure on the consumer. If we look at the outlook, demand remains strong and the demand didn't change. The macroeconomic conditions will lead to price escalations that will put pressure on sales. The outlook is still positive, although measured, with a focus on infrastructure during the market uncertainty. The reality is that developers need to bring better located projects to the market, close to the job opportunities, alleviating pressure on the consumer by saving on transport cost. The Memorial Parks business, the market demand for premier burial spaces remain high. Our footprint is expanding and we see a focus on new entrants, on people coming into the market segment, addressing where public sector is failing to provide a service. The Memorial Parks is an attractive option currently because of a different group. On the outlook side, we see that the reservation sales is expanding and organic expansion through the repurposing of group-owned land previously earmarked for mid to high segment of the market. The group's strategic priority is to create shareholder value, and we see that through the driving of long-term growth, the strengthening of liquidity, and enhancing shareholder value. Okay, that brings us to the end of our presentation. We will now go to the Q&A section. You are welcome to add your comments or your questions in the comments box, and so you and I will address them.
Thank you so much. Mark, you happy for me to kick off?
Just one quick comment just from my DMs, if we can, before we start, and not a question, more comment just from somebody on the call today saying to thank you to the Calgro team for making time to engage with private investors. It's very much appreciated. So I just wanted to pass on that before we kick off the Q&A proper.
100%. He's warming you up for the tough questions here. Thank you so much for this, and to everyone who's attending, welcome. Please do send through those DMs. So I'm going to start us off just with the macroeconomic situation. I mean, you've touched on it there in your outlook, and I think you've rightly pointed out that things have changed a lot recently. But the question that I really want to ask is, property development feels like it's in the crosshairs of a macroeconomic environment where interest rates maybe start going up. Hopefully not, but anything is possible. You've got big inflationary pressures. You've got consumer affordability issues. Worst case scenario, maybe a full-on recession. I mean, who knows? None of us know. And the situation changes in Iran daily. But in terms of where you guys are at with your balance sheet, the debt you've got, the relationship with lenders, I mean, the need to refinance and look at some of that has come through in this presentation. Perhaps you can just give investors some more, I guess, just comfort around how you're feeling at this point in the interest rate cycle. How resilient is the business at the moment?
Thank you. I think if I start off, the demand in the residential property market, the low end of the residential property market didn't change. We know that. Property is a long-term cycle, so we're taking the longer-term view. Saying that, the consumer that we expected confidence to recover, we saw in the previous reporting period that the interest rates were coming down, the consumer were recovering, but the investor market recovered faster than that man in the street. So our focus tended to lean towards the bulk sales, where we sold units to investors that putting units back into the market for the residential market. So if you look at where we find ourselves now, the consumer is under pressure. I think it's going to be important to bring better located projects to the market, like I said. We need to make sure that consumers don't spend 30% of disposable income to get the job opportunities, because that will keep the consumer under pressure. And then there's also going to be a focus at looking at how do we lower that barrier to entry? How do we go cheaper into the market, more affordable into the market? What is the products we can bring? And I think the banks are joining us in that effort to say, how do we look at the lower end of the market by taking into consideration the rental income when purchasing units. So yeah, we are in a changing market.
If I can just touch on the other side of the business, Memorial Parks, I mean, continues to perform very strongly. I do just want to touch on the 2.4 billion development pipeline. Maybe, I know you said in your results presentation, your bank felt is like a 15-year project, but maybe this 2.4 billion, what that encompasses and kind of what timeline is attached to that 2.4 billion.
Yeah, looking at the Memorial Parks pipeline, we've got 6 operational parks now. We're taking a 10-year, the pipeline will service us for 10 years in the current format. We've got the Fourways Memorial Park and the Durbanville Memorial Parks that will reach capacity first. We're currently looking at replacing the capacity on that and expanding our footprint in the vicinity. So yeah, that pipeline will service for the next 10 years with the intention to increase our footprint. We would like to see an increase in our market share as well as our organic growth in this business.
Yeah, and I think just to add to that, Ben explained the strategy in the presentation, but our strategic objective for Memorial Parks is for it to grow, to assist us in entering into projects like Bankenveld. With the ability of that increase in the cash collections and covering various group overheads, we are able to enter into these mega projects and these projects that are quite capital intensive. And that's really what backs that growth strategy that we're looking for in Memorial Parks. Currently, from a growth perspective, we are looking to repurpose 2 pieces of property which sits in our property development business, which were in the mid to high range. So definitely not a core business for us. and repurpose them as memorial parks, as they have very close proximity to the Four Ways Memorial Park. We've gotten the first consent used to do so, but we'll obviously need to go through the host of rights changes to get it into a park. But there is a plan for the organic strategic growth of memorial parks, and it will help us in order to get into very capital-intensive processes in Duncanville.
Maybe just on the memorial park, since it's come up. So I feel like we ask this question every time, but obviously it's important for investors to always get the updated view on it. And even when I look at the numbers, I sometimes wonder. So if I saw the numbers correctly, and I hope I'm not getting them wrong, the maintenance provision, I think, was around 66 million Rand, roughly. And it looked like revenue from the parks was around 86 million for the year when I looked. So I guess the relationship between the provision and what this thing turns in just 1 year, I mean, it feels like the best business in the history of Earth, which obviously makes investors wonder, what's the catch? It feels like an eternal liability because you have to just keep maintaining these parks forever. So obviously on the provision, I would think those very long-term cash flows, by the time you present value them, they kind of come down to a small number. And that's the financial answer for it. But just from an investor perspective, I mean, can you just keep selling spaces basically forever to the point where the very, very long-term almost doesn't matter? You understand what I mean? It's got that like too good to be true flavor to it. And I know that comes up from investors when I speak to them about Calgro and they ask me questions.
I think the first thing to look at the growth that the parks are currently experiencing with the introduction of the lay-by product. So we looked at a way to lower that barrier to entry when people acquire that. So we introduced a lay-by product. Those lay-bys are over a 12 and a 24-month period. So because that is now reaching maturity, as having started that 3.5 years ago, that growth of 59% looking at that is not sustainable, because that's the lay-bys that's maturing, and in the past they weren't maturing as fast. I think we see our growth organic, and we'll also increase in market share.
Yeah, and I think just on the differential between that revenue and the provision, so you're quite right. I think it is the discounting impact that brings it back to a much lower number. However, the cost to incur once the park has reached final maturity, and that's when we will start dipping into those particular investments that we've put away for that. Your maintenance cost is much lower than what we currently incur from a maintenance perspective. It's basically your security guard at the gate, admin person at the office, and then grass cutting and watering, really. So the cost drops quite a bit. Where we spend money currently is on the digging of the graves. That is the most it's the largest portion of the cost base currently, and that will fall away once the park is completed. Then, as Ben Pierre mentioned, that recognition of revenue for the lay-by product, and just to touch on that because we always do discuss it. We only recognize revenue from the sale of a lay-by grave upon final payment of the grave. So that maturity cycle now has started to come through very nicely, and we see consistent lay-by maturities. But at the same time, we see good growth in our lay-by book. Now, yes, that does have a ceiling because the market is only as big as the market is around the parks, but that's what's really spurring on that strategic growth aspect, to grow into different areas and localities in order to grow the footprint of the park.
And if we just talk about, I know you're disposing of some non-core assets, but you're still keeping your eye open for strategic assets elsewhere, land parcels, undeveloped land. Is there a preference between Gauteng and the Western Cape? And I'm going to say, could that shift, depending on the outcome in the municipal elections scheduled now for the 4th of November by the president?
I don't think the election should influence that. I think what's important to note, we like the diversification. We like to spread our risk between Gauteng and the Western Cape. We prefer not to be dependent on just the city of Johannesburg or just Gauteng province. So doing business in Gauteng and the Western Cape, that risk diversification is attractive to us. But I don't think the outcome of the election should affect that.
And if I just add on to that, I mean, we're starting to see reports, just given where property prices are in the Cape, you know, a kind of a regress migration of, you know, people from the Western Cape to back to Gauteng, or people just like kind of leaving the Western Cape up to Gauteng for the cheaper property prices and the job opportunities, given is the like commercial industrial hub of the country. Have you started to feel that on the ground to any certain extent? Is that, you know, you guys are based in Gauteng, you're in the property business in Gauteng, is that narrative that's kind of flowing through the media, is that starting to show up in sales and kind of, you know, the broader property people you speak to in the sector?
I think for starters, Western Cape became expensive. There's no question about that. So putting up a project of scale in the Western Cape might require a big investment. It's not our intention to go and invest into big parcels of land, greenfields, to be developed. We're currently in talks with the provincial government in the Western Cape with regards to our integrated model and how we do business up in Gauteng. Western Cape does not have any exposure to multi-story, fully subsidized units, for example. They treat their social housing as standalones. So we're spending a lot of time with basically educating the Western Cape with regards to what's possible with integration. And the ideal would be to do a development partnership with them and not go and overcapitalize in investing in specific parcels of land in the area.
And I think we must just, when we consider, you know, the move out of the Western Cape back into Gauteng, we must consider the LSM, which that sits in. In our particular market, our LSM is really, you know, that entry level, you're walking into your first home, affordable market. So I don't think the move from the Western Cape back to Gauteng has a significant impact on our demand necessarily. And again, us expanding in the Western Cape provides very, very good affordable housing options to those people that are there.
So we've reached that point of unlock the stock with you guys, where the words share buybacks are now blowing up my DMs. So we may as well get there. Obviously, even more interesting this week, right? Because we've got the news of Bullwin being taken private, which you guys knew would come up, I'm sure. So lots of questions around that. I think let's try deal with them in an appropriate amount of detail, which I think let's start with share buybacks first. So I think the market loves share buybacks when companies are undervalued, obviously. Perhaps you can just talk to the way you think about share buybacks as an allocation of capital, your plans there versus, you know, the many other needs for your capital.
Yeah, I think for starters, I think the priority will remain that capital commitment we made into growing the Bankenveld. So I think that commitment to Bankenveld will be the first priority. We do see the opportunity with regards to share buybacks, dividends, all that. But as long as we know the priorities need to be balanced between the share buyback, the dividends, and the actual just the growth, and putting us in a position where we can actually grow into Bankenveld. So we need capital to grow into that. So it's a set-off between the two, but share buybacks definitely not off the table.
If I can maybe just press you on that before Mark jumps back in. So just the split between share buybacks, divvies. I mean, I think that's a big question among your investor base, is like recognizing Bankenveld's got to be your, I mean, it's your core business, right? You've got to do that first. Otherwise, what are you doing? But after that, is there a waterfall where you apply the priorities? Do you feel like a cash dividend is needed? Could you go full buyback? Just curious about the flexibility there.
We don't see the need for the dividend. I think the share buyback is definitely competing with the capital allocation. So I think the dividend policy will be reviewed during the year again. The board resolved to keep the dividend unchanged, just not to change it without proper deliberation around that. But we are having chats about that and say, guys, looking into the future, is it necessary to pay a dividend at a time when your debt is going in the wrong direction? And or is it not more accretive for shareholders, the buyback of shares? So it's definitely on the table and in discussion.
Yeah, to give you some color around what the way that these decisions are looking. We're spending quite a bit of time with our investment committee around just this, you know, the mix between the share buyback, our general return on invested capital, on the projects that we currently are rolling out, as well as the accretive value that it creates, and the dividend policy. So the dividend policy did remain unchanged, as Ben Pierre mentioned. However, the dividend amount that we pay out based on the actual 5% of HEPS policies wasn't deemed to be too significant to general working capital requirements in the current year.
I've got a question in my DMs. It's around the Veenavel non-core project, but I want to kind of broaden it to the other non-core projects because the question is kind of the same. Timeline for wrapping up all of these, that project, the other non-core projects, if we're sitting here, 12 months hence, should all of those non-core projects kind of be traded out and wrapped up, or is there still a few that are going to take, maybe another 2 or 3 years to fully wrap up and exit? Just maybe touch on maybe the timeline to get those off the books, okay, cash in that can be then redeployed into Bankenfeld and elsewhere.
Mark, I think the short answer is no, it won't be completed in the next 12 months. If you look what happened in the Veenavel, that's been classified as non-core. We'd like to exit that market segment. We sold more units in the year under review than the previous year combined, so we're definitely ramping that up and we're accelerating that exit. But that is a 24 months view that we're taking on Veenavel. If you look at the units we inherited when the REIT was unbundled, in Southfields, for example, we sold 50% of those units we held a year ago. So once again, a little bit higher in the market, the 1.2, 1.3 market segment. We were able to offload half of that stock, so let's give ourselves another year on that. Scottsdene, the trading out of Scottsdene, there was a big focus on that. We transferred 266 units in the reporting period, and it was just of about 366. We started construction on 140 units that's currently under construction that will be traded out this financial year, and that will leave us with 80. So there's a big focus on trading that out, with receiving quite a bit of priority and capital allocation currently, but it's not something that will be resolved in 12 months. We're taking a little bit of a longer view, but we're aggressively trading that out.
And just the reason for that is, unlike the non-core assets, the non-core projects actually need capital injection, and it needs the construction process to complete before it trades itself out. We don't have any intention to go in there and do a very quick exercise just to get out of there. We need to be able to receive the margin that we are due for those particular projects, and that requires that longer term investment and just going through the full construction cycle before we are able to get the returns from those.
Another question inspired by the happenings at Baldwin, surprise, surprise. So I think what's become quite clear is certainly the government's pockets, well, we know they're deep because we all pay our taxes very nicely, but we also know that affordable housing is important to them. So that seems like a pot of money. And I guess the question is, particularly as in my DMs, the person asking the question has made it quite clear that they don't want to see a equity capital raise at Calgro level, understandably at the current share price. But you could go and potentially get equity partners at project level if you needed to. And maybe that's a good way to, take some of the cash burden off, ramp up share buybacks. I mean, just from my side, I think that with some good structuring there, you could create a lot of value. I guess the question is, would you entertain bringing on significant equity partners at project level and doing that sort of financial engineering and capital allocation?
I think the first answer is there's a lot of focus on us because of the market segment we're currently addressing. Public sector is very vocal about doing public-private partnerships. So I think there's more than one option. There's options to get access to the infrastructure funding, and how we do that. That's a process we're currently looking at. It's something that's been coming for a while. And yeah, if you look at Baldwin specifically, they're in a different market segment than us. They're leaning towards the REIT business of retaining stock. We've got no intention of going that direction, and well done to them and good luck.
Maybe if we just carry on from that. I know there's been a few media reports down here, some of the big Air Force bases that are based in Cape Town are, selling off parcels of land there. I mean, would they be, of interest to Calgro as part of that broader partnership where you can say to the Western Cape government, here is now state land that is looking to be divested, let's put a joint bid together and put in place a project like we have done on kind of multiple occasions in Gauteng.
Well, definitely, there's discussions underway with the province and with the city. The city of Cape Town's got 9 military bases that they don't specifically all need. Western Cape government also indicated that they will look at it and make them available. Depends on what market segment you're looking at. So definitely an option. We're having discussions around that, and yeah, let's see where this one goes.
Mark, I don't know if you've got any more. I think we've covered a lot of the stuff that's in my DMs, which is mainly around capital allocation. So I think that's important feedback to management on that side. That's definitely top of mind for investors, without a doubt. I guess that's the reality of trading at this kind of discount. Mark, was there more from your side? You're on mute. Rookie error, Mark, on mute. Oh no.
I'm just double checking now on this side. Have I make sure I haven't missed any or got one? No, I don't have any more. So maybe we might wrap up a bit early and let the team there grab a sandwich. It sounds like they've been trapped in the boardroom there all morning. So I'm sure they're back to back, so they can squeeze in a quick sandwich and a coffee between now and probably a 1 or 1:30 engagement with the rest of the results roadshow. But I will just ask Jonathan if he could just bring up, yes, and there is the details. If you do want to be added to the Calgro M3 distribution list for all their updates and the next set of results. And that just leaves me to just mention our next session, which is next week, Thursday, the 28th of May. This will be a new company to the platform. Very excited to have Foresight Holdings joining us for the first time here on Unlock the Stock. So please do register for that. The invite has already gone out. You'll find it on our social media channels, or if you should have got the email if you're on our Unlock the Stock email distribution list. I will leave it there. Thanks to the team for Calgro. Thanks to my co-host of finance, Ghost, for doing this solo, without the team from Keyter Rech today, who are out and about on various results roadshows of their own. And we'll leave it there. Thanks, everyone. Have a good rest of their Thursday.
Thank you.